should brace for higher interest rates in the coming months after Parliament passed the Finance Bill amendments, which will see rate caps scrapped. This will mean commercial banks will now be at liberty to charge interest rates as they please on loans. The umbrella body representing banks in the country, the Kenya Bankers Association, notes that the revised rates will hit at about 3% to 4% higher.
The latest twist to the rate cap debate has jolted many Kenyans, even as Parliament failed to rise up to the occasion to safeguard interests of borrowers. According to the Kenya Bankers Association, repealing the rates will not significantly affect the cost of credit.
The narrative about the repeal of the capping being to the disadvantage of the SMEs, I think is a wrong narrative. The right narrative is the fact that actually the repealing of the caps will support the development of the SMEs in terms of them being able now to access credit from the banking sector.
It's true that with the interest rate cap, we saw a reduction in lending to the industry for micro and small enterprises. But if you look at the total lending portfolio, we're lending nearly 220 to 300 billion every year to these segments.
The push to have caps lifted has been anchored on a reduction in credit uptake in the country. Data from the Kenya Bankers Association shows that after introduction of the rate cap, loans to SMEs and companies dropped by 1.9 trillion shillings. At the same time, personal loans, which often support enterprises, went down by 5 trillion shillings.
Between 2016 and today, during the era of the rate cap, there's 1 million customers that used to be able to borrow that are no longer borrowing. It's 1 million customers. That's a large number. Where have those customers gone to? I can tell you, they're in Sherlock's, they're in the tellers, they're in the branch, paying 70%, 100%. That's where those customers are.
Implementation of the revised rates is expected to take effect once President Uhuru Kenyatta assents to the finance bill. Banks, on the other hand, have maintained that pricing of loans will not be hiked past the average market rate.
Nothing changes tomorrow, if you want the specific questions, because the risk is already priced in what we have for the customers.
For now, consumers will be keen to know whether a revision of the rates will affect existing loans, which many fear that if this is implemented, it would worsen their repayment plans, with the cost of living already rocking a sizable portion of households. Abia Gina, KTN Business.